Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. If you're here with us for the first time, you may not know that. If you are here for the 100th time, you probably are familiar with me and with my chat partner today out there in the chat, my good friend Connie Hill, 20-plus year veteran of the financial markets. She's there to help facilitate the conversation. So whether you are here for the first time or always you are here, thank you for joining us. If you're here in the recorded version, we're glad to have you here as well. Remember to leave a comment in the chat or in the comment section if you are in the recorded version. For those of you that are here in the live version, leave us a question or pop in a question or a comment there in the discussion. We'll keep that going on. Now, as we get started here today, a couple of quick housekeeping items because, it is Fed Day, and so that's moving the market around. A couple of things that we want to pay attention to. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation or advice about any particular security or strategy or idea. Also, remember that investing involves risk, including the loss of principal, past performance, no guarantee future results. Now, one specific thing that I do need to call out is the fact that equity and index options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics or risks of standardized options before you consider any option strategy or idea. Remember that when we talk about index options, generally, we're going to be discussing European-style options, which do not allow for exercise of those option contracts until expiration. That means that there's no early assignment risk. But if you're trading something like an equity option or some of the indexes that are American-style options, those American-style short options can be assigned at any time up to expiration, regardless of whether they're in the money, at the money, or out of the money. It doesn't matter. So one of the things to pay attention to also is the fact that as we get closer to expiration, there are some specific risks that come up, including liquidity risks, price slippage, and gamma influences on price movement that cause prices to move very, very quickly one direction or the other. So be aware of that and be aware of some of those characteristics as we get into some of those shorter duration options. We'll talk a little bit about that today as part of this conversation. Also, we're going to be using the Thinkorswim desktop software platform today. It is a great learning environment, especially the paper money version of it, which is what we're going to use. It is not, however, guarantee future success out there in the real world. It does not facilitate things like early assignment of short options in the paper money version, whereas a live trading environment will allow for that early assignment if the options allow for it. So just be aware of those differences as you move your practice from paper trading to live trading. That there are some differences there. Of course, we're going to use some technical analysis in this discussion as well. Not a guarantee ever. But no form of analysis is a guarantee of what might happen because, as we know, news happens and it happens frequently and it happens often and it happens without warning. So let's do this. Let's pop over here to the Thinkorswim desktop software platform. Take a look. So on the heels of the FOMC meeting and kind of right in the middle of the press conference, we have an unchanged, for the first time in a few meetings, we have an unchanged interest rate decision. The parsing of that conversation and what it means is very likely what's creating a little bit of this downward movement in the S&P 500 today. In fact, the SPX, and I was on the network earlier, the Schwab Network brought to us by our media affiliate, Charles Schwab Media Productions. And one of the conversations was the brief blip of the SPX historically, for the first time ever, to above 7,000. In fact, going to 7,002.28. It didn't stay there. It's got to close there for everybody on the exchange to get a hat that says SPX 7,000. But I don't know that it's going to get there. We're now sitting at 69.77, and it seems to be pulling back a little bit here. RSI indication of momentum still moving to the upside a little bit. The NASDAQ pushing out some new highs here as well today. 261.65.08 is where it touched today. Coming down, it's now at 260.59.5117. I would love one of those hats. I've got several inside sources placed on the NYSE, our anchors at the NYSE for the Schwab Network, who are going to try to acquire one for me. So hopefully Sam, Nicole, or Diane will grab one of those for me. All right, if that does in fact happen, and probably not going to happen today. But starting to see that SP or the NASDAQ kind of pull back a little bit here as well. Russell 2000 started up a little bit higher here, kind of gapping up to the upside. Saw some strength in those small caps and then selling off just a little bit here. But nevertheless, what's interesting about the small caps, the Russell 2000 here, this index is kind of staying, if you will, maybe even a little bit more sideways than some of the other indexes. We saw that big run up and it's now pulled back, which is a good thing because we happen to have an example iron condor trade on this particular index. So we'll take a look at that here in just a minute and see how that's playing out, seeing if it's staying within those navigational beacons or buoys. At this point, we'll see how we might manage that as it begins to move. And I want to take a look at a couple of other things here really quickly. I want to pop over here to our VIX grid and take a look at what's going on with the volatility index. And the VIX, when we were talking last week, was up near that 20 handle. Volatility had increased a little bit. It has now come back in just a bit, despite the fact that we had a Fed meeting. In fact, maybe because of the fact that we had a Fed meeting, there was a little bit of wait and see, so there wasn't actual volatility. I think that perhaps there's, given the potential for market moving activity, especially geopolitical risk and other things, that maybe this VIX is a little bit low, but that's just the gospel according to me. That is not in any way, shape, or form any kind of advice or recommendation or anything else. So that being said, volatility is kind of back down and got crushed back down into that 16 range. If you remember, if you were here with us last week, we took off that volatility, actually a couple of weeks ago. We took off that volatility-based long vertical spread that we had on the VIX index, wherein we were looking for upside movement. We're looking for the VIX to continue to move to the upside. In fact, it was rolled from a diagonal into a vertical spread. At the moment, the VIX is kind of settled back down. And that's one of the risks of trading a VIX index trade, is that the VIX tends to be very, very much so mean reverting. Meaning, by mean reverting, these spikes in the VIX that we're seeing here, even big spikes like this, but certainly these little spikes tend to be absorbed very, very quickly. They tend to be met by selling pressure on VIX index and VIX options as well as SPX options. That brings that price down pretty quickly and it mean reverts back towards its average. I've got the 30-period moving average on here. That's the blue line. That's the 30-period moving average of what essentially the index construction of the index is the 30-period average anyway. So an average of an average, it kind of gets to that middle ground. That's where it's mean reverting. And you can kind of see the tendency of this index to come back down to those ranges time and time again. And so that's where it is now. We're kind of sitting at about that 16 handle, just above that average at about the 15 level. So not at all unusual to see kind of that relief of fear, if you will, post something like a market moving event or potential market moving event like the FOMC meeting. Now the news is known. Now the volatility drains back out. And that's where we are. That volatility is kind of drained back out, which works for us if we are short options. Volatility increasing works for us if we are long options. So in something like a vertical spread where we are long and short, what really determines whether or not that is volatility sensitive is which one is the driver. So in some of the short vertical spreads that we've been taking on and looking at as examples, volatility decreases are beneficial for those trades. So for example, the trades that we have been making on a fairly regular basis, moving from 14 days to 7 days, selling the vertical spread at 14 days to go until expiration, buying it back at 7 days to go until expiration, that benefits from not only rapid time decay, but also benefits from a decrease in implied volatility. Let's take a look at an example of that and kind of work through that. And then I've got a couple of other ideas that I want to talk about here. And some exciting news. Again, I'm going to temper this, but some exciting news from Cboe Global, the Chicago Board of Options Exchange, the options exchange that generally lists the majority of the index options that are out there, but in the equity option space. So I want to do a compare and contrast here in just a minute between some of those new expirations that they are listing versus index options, because there are some similarities and some differences, and one of these things is not like the other. So let's pop over here to the monitor tab. Let's take a look really quickly over here at our weekly options and our index options. Here's our Iron Condor trade on the Russell 2000. We'll come back to that one here in just a moment. But we're going to take a look really quickly at this one, which is our 14-day till expiration, 7-day to go until expiration SPX short vertical strategy. And for those of you that have been following along with this strategy for a number of weeks, we've been doing this for over a year now, week in, week out, generally. And when Connie has followed along and helped out with one of my webcasts when I've been on the road, Connie has also, I think, kind of kept that rolling right along here. But the idea is that at 14 days to go until expiration, and it just happens to be Wednesday because we teach this webcast on Wednesday. But you could do it on Tuesday, you could do it on a Monday, a Wednesday, a Thursday, a Sunday. You couldn't do it on a Sunday. But Monday, Tuesday, Thursday, Wednesday, doesn't matter, to quote The Godfather. All right, so here's what we're looking at. We sold this vertical spread, the 6660 put on the SPX, and we bought the 6640 put on the SPX. Short put vertical spread, bullish bias, expecting the index to continue to go up or simply go sideways. The index went up, and time passed, and implied volatility dropped. We saw the drop in the VIX that we just looked at. So this vertical spread that we sold for $2.10 per share times 100 shares is now trading at 32 cents, 32 and a half cents, if you will. So buying it back now at 30 cents, we've captured the majority of the gain that we could potentially make in this particular trade. In this particular case, we're very rarely, if ever, going to get to max theoretical gain in the trade. We're probably never going to get that $2.10 because we're taking the trade off prior to expiration. The reason we're taking this trade off prior to expiration is this. This is a $20 wide. Let me just go through this really quick. This is a $20 wide vertical spread. So $20 minus the $2 and that's a 2.10 that we brought in means that our risk in the trade was pretty significant, right? It was $20 minus the $2.10, the credit that we brought in. So we're carrying that risk in this trade until we close this trade down. So now if we sold it for $2.10 and we're subtracting from that the 30 cents that we'd have to spend to buy it back. So now what that means is, if we think about this, that gives us that opportunity to claim, sorry, I got to do this here real quick, $2.10. There we go. Just want to get my math right. So that gives us that opportunity to claim the majority of that max theoretical gain. So if we think about what that represents, our max gain theoretical when we put the trade on was the $2.10, and we subtract from it the 30 cents. We made potentially $1.80 in the trade, so that's about 85% of that max theoretical gain in this trade. And I'm okay taking the trade off at this particular point. And as a trader, some traders may consider looking for a little bit more. Some traders may look at taking it off sooner. But if we can capture, in this case, roughly 85% of that max theoretical gain, and then redeploy that risk again and bring in, once again, over the course of a week, another 180, and then do it again and then do it again. And I'm not suggesting that we try to annualize that, because every trade in this case is different. But that's the repeatable kind of rinse and repeat nature of this idea and this strategy. Again, it is subject to risk, and it can change because of news. So I just want you to keep in mind all of these ideas as we look through this trade idea. Let me kill those annotations really quick, and let's kind of go to our next step. So the next step here in this particular case is to take this one off. So all I'm going to do is I'm going to right click, and I'm going to create a closing order. We're going to buy that back. And as that's been bouncing around, you can see that that's been bouncing around from about 30 to 35 cents. I'm going to put this in as a limit order to buy it back for 35 cents or less. I'm fine if I can get out at 35 cents. That's still roughly 80% of the max theoretical gain in the trade. So I'm going to go ahead and click on confirm and send, read through this order to make sure that that's what I want it to do. There's my 35 cents right there. And I want to make sure that it says to close. And I'm going to go ahead and send that off, and we'll find, and get that we bought it for 35 cents. That's fine. I'm okay buying this back for 35 cents, taking that trade off and eliminating that risk, that $1,900 risk that we had in the trade. Now, we didn't get to max theoretical loss in this trade. We've only done that a few times. We have taken some trades, and you've seen it as we've done these trades. If you've been here with us, we've taken those max theoretical or we've taken some loss on a number of occasions. Some loss on a number of occasions is better than taking max theoretical loss all the time. Now, what that means is we're defining the risk in the trade, but we're not necessarily managing or repairing or even putting a stop order on this trade. Simply because of intraday volatility, we don't want to get kicked out of the trade prior to it doing what we had expected it to do anyway. So now let's do this. Let's come back over here to the chart, and we're going to change this chart grid to our index options grid for the SPX. Now, for those of you that are brand new, I'm going to put this out in the chat. For those of you that have been around for a while and maybe you've forgotten about it, or if you were watching this in the recorded version, I will make sure that this is in the description for this particular webcast. So I'm going to go ahead and I'm going to share this grid. And remember, anytime we share anything, whether it's a script or a chart grid or it's a watch list or anything else, that's for illustrative and educational purposes only, number one. And number two, not guaranteed as to time or accuracy. So there you go. It's out there in the chat. So the first step in this strategy, this 14 days to go until expiration, 7 days to go until expiration, is identifying on this SPX option chain when our next 14 days is. So that's the 11th of February. So just 7 days out from today. Now, here's one thing I'm going to say, and I just mentioned this briefly at the end of the webcast last week. Some of you may have caught that. But there's no reason that this has to be just a trade that you do on Wednesdays. There's nothing magical about Wednesdays. There's nothing magical about Mondays. There's nothing magical about Tuesdays. There's even nothing magical about Fridays. Although, Fridays are a nice day. It's the start of the weekend, right? Here's the thing. On an index product like SPX, when there are expirations essentially every day, a trader could consider laddering this type of strategy. So we could say, all right, fine. Here we are on Wednesday, and I'm going to sell the 11 Feb short put vertical spread. And then tomorrow, the 12 Feb expiration now rotates into the 14-day to go till expiration slot. And so we could sell a 12 Feb expiration short put vertical spread, same rules. And then on Friday, The 13 Feb rotates into that 14-day period. And so we could sell one on that one on Friday. And so every day of the week with daily expirations on this index, a trader could add another short vertical spread. So there's always one coming on every day, and there's always one going off every day, if that makes sense. Now, that depends on the trader's desire to be active in managing this strategy. It depends on the trader's capabilities of managing that much potential risk over, say, 5 trades that carry, $1,900 of risk per trade. Or if you were doing this on another index like the XSP, which is the smaller, that risk would be less because the spreads would be smaller. You don't have to be 20 points wide. There's a lot of different varieties and variations that a trader could use. The point being, that's one of the benefits of trading index options is the fact that there are, especially in some of these very liquid products like the SPX, many, 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 many expirations that allow granularity for different strategies. So we're going to go down here to 14 days to go until expiration, the 11th February to go until expiration. Okay, 11 February, 14 days to go until expiration. Now, what we're going to do, now that we know that that's the date, we're going to go back to that chart. And I'm going to take my time hack, which is just simply this line right here on the drawing tools. It says time level. And I'm going to right click on it and whoops, I didn't want to do that. Right click, remove, let's see, remove drawing. We'll just take it off there. I'll put a new one on there. We'll go right there. And now what I'm going to do is I'm going to move this out. We're going to put that line in place. And we know that we were out to the 11th of February. That's right there. That's the 11th of February. And we're going to click. Now, what this chart on the right-hand, exactly, Ricebird, yes. What this chart on the right-hand side has is what's called a probability of expiring cone. That probability of expiring cone, which is a study that we can choose just by typing in the word probability of expiring cone. That is a study that shows one standard deviation. One standard deviation. Now, Ricebird asks a great question as we do this. Is there any particular time of day? And I would argue, I do this simply at this time of day simply because that's when this class goes off. But if you were to see throughout the day of that expiration or that 7-day time frame, if there was a better time, and this is great opportunity for traders individually to do some research. If there was a time during the day, I would, and think perhaps once that intraday and start of the day volatility works its way out, as Laura points out, avoiding the first 30 minutes of the day, might be a time at which that trade could be taken off after that first 30 minutes of the day, just to avoid that early morning getting started volatility. Because remember, the SPX, being an index, is going to be based on the, at least as it starts to get moving, is going to be based on the movement of the components of the S&P 500. To get to the print, all of those components of the S&P 500 have to be working, right? Have to be trading. They don't all open at the same time, at least the options don't. And the trades don't start happening all at the same time. There might be some instruments that are trading first, and then some that finally get around to opening and trading. So the first 30 minutes of the day, as all of that volatility settles out, that may be a time potentially for options traders to avoid. And again, it's also one of the reasons why potentially some options traders avoid using stop orders, especially during that particular time, because that intraday volatility could kick that order out pretty quickly, and then it goes on to do exactly what you wanted it to do. All right. So as we start to do this, as we start to look at doing this, what we're going to do is we're going to move that time hack out here on that line, that timeline out to the 11th, and then I'm going to simply take my line tool, and I'm going to draw a little hack right here. In this case, we're going to go to the 67.75 strike, where that's crossing over and the intersection of time and one standard deviation. So here's the great thing about that particular tool, Harry. That probability of expiring cone adjusts to the time frame of the chart that you are looking at. But remember, it is based on its little time increments are based on options expirations. So you may see, if you're looking at it on a shorter term chart, you may see that probability of expiring cone be much, much wider than the range of your chart. So you might have to squish your chart in to get that cone to fit within that time frame. If we've got time, I'll take a look at that and we'll show you what that means. Now, nevertheless, we're going to sell a short put vertical here at the 67.75 strike. That's where we're going to sell that that short strike, that short put strike. Why are we using a put vertical spread? Why aren't we fading this upside move? Well, we're doing this simply because the 200 period moving average is still trending up and the price of the index is still well above the 200 period moving average. If it were below the 200 period moving average, like it was down here, we would be selling call spreads. We would be selling call spreads. Now, as we start to look at this, we're still selling put spreads because we still have a bullish bias in the market. I know the perma-bear contrarians out there amongst you are saying, yeah, but it's too high. It's got to come down. It touched 7,000. It's got to come down. Maybe. Doesn't got to do anything. So let's go over to the trade tab. And let's take a look. Here we are down to the 11 February expiration. I've got to add a few strike prices here. I'm going to go out to probably 120 strikes. And we're going to look out here. We're going to say 67.75. And by the way, I'm going to change this to my layout to Delta Theta Vega. And I'm going to go to the 67.75 strike. That's right here. That's about the 16-cent delta. That's about where this has been falling. That's just kind of running into where about that one standard deviation range is. Okay. So we're going to click on that 67.75 on the bid price for that 67.75. We're going to sell that for $19.60. Now, if we were to just leave that right there, that would be a short, that would be simply in this case, a short put. If it were going to be a cash secured put, here's how much cash we would have to hold in our account to just sell that short put. $675,560. That's this index going all the way to zero. So that's a not very capital efficient way to use capital to hold that much cash. And if we were just trading this as a cash secured put, that amount would have to be set aside. So in most cases, that's either going to take up a significant amount of traders' capital, or traders not going to be able to do that. That's why we create this as a vertical spread. So now what we're going to do is we're going to add in the mix here, 67.75, and we're going to buy the 67.55, so 20 points wide vertical spread. And we're going to buy that one. That's about the 15 delta. We're going to buy that one for about $17.80. So look at that. We're getting $2.10 a credit. That's about where we've been with volatility in about the 15 or 16 handle. So theoretically getting about $2.10 of credit on this trade. And in fact, we could bump that limit up a little bit and try to work the order just a little bit, see if we can get a little bit more than that. But I'm going to go ahead and I'm going to click on confirm and send. I'm going to read through this order to make sure this order is what I want it to do. And I'm going to put this in my index options weekly group. Make sure that this is to open. We're opening the vertical spread. So max theoretical gain in the trade, 210. Max theoretical loss in the trade, about 1,790. Right? So the difference between what we're bringing in premium and the width of the spread times 100 shares, which is cool. I mean, I like that from that perspective because not only do I know what the potential gain might theoretically be, but I also have defined the risk, and this risk and the amount that this is going to impact my buying power is significantly less. $1,795 is significantly less than $675,000 that just short put would have dinged my capital. So I'm going to go ahead and click on send. fire that order off. We got it for 210, and now it is out there, and we're just going to let this decay away. We're going to let this work for a week. I'm going to watch it, but I'm not going to touch it. I'm not going to manage it. I'm not going to take it off early. There's a reason why. And we've talked about this before. I'm just going to briefly explain the reason why. The reason why is that in an out-of-the-money option, this is an OTM option, the time decay curve that we're normally used to seeing, which is kind of this nice, logarithmic, accelerates as we get close to expiration curve, changes. It flips. It almost inverts. What it does, it means that the long out of the money or far out of the money options, when we're short those options, they are, well, actually all of those options are losing extrinsic value. The time decay is happening to the greatest degree and the greatest rate in the first portion of the trade. So if this is, so we've got 14 days to go until expiration. That's the whole time frame right here. The greatest amount of time decay happens in this trade from day 14 to about day 8. And then we get a little bit of time decay, but then it kind of slows down and flattens out. So this is 7 to 0 days to go until expiration. The majority of the time decay happens in the beginning of the trade just because of the mathematical nature of theta. That's why this is beneficial to do that shorter term time frame and take the trade off and not let it go all the way till expiration, because it exposes us to risk for too long a period of time without corresponding return in the impact to the trade. So because of that, that's why we look at this 14-7 time frame and look at taking that trade off at 7 days to go until expiration. All right, so 2 more things I want to look at really quick. Let me pop over here really quickly to our monitor tab once again. And let's take a look at this index options trade that we've got on. This is our Iron Condor. We've got 23 days to go remaining on this particular trade. This is our Iron Condor on the Russell 2000. Our navigational buoys in this case, where we define the range that we want the Russell 2000 to stay, are defined by our short strikes, 2,500 and 2,600, fairly narrow range. Where is the Russell 2000? It's at the 2656 level at the moment. So it has now buried itself kind of above, if you will, our short call vertical spread. That's why this one has gone into the money and this one's gone to just about 0. So this one's trading at about, at the moment, this one's trading, the short put vertical spread is trading just about $1 here. So we've lost about 60 cents in this trade. This one's trading at about $7. So we're just about an even on this particular trade, actually up just a little bit on this particular trade. So if our expectation is that the Russell 2000 is going to pull back a little bit more, what we might do is just leave this trade to continue to work. We could consider rolling this call vertical up for space, give it a little bit more headroom, but that's going to probably cost us some money to be able to do that, which now might be inducing more loss in the trade. So that's a careful consideration that we want to make in terms of managing this trade. At the moment, we're pretty close to that in the money time frame. So what that means is that rate of time decay is still working pretty rapidly. That's kind of working in our favor. Implied volatility going down, that's working in our favor here as well. So I'm going to leave this in place for 1 more week to see if we get a little bit more bleed off. Now, remember, here's one of the things. When we're talking about 2 short legs here, the 2,500 put and the 2,600 put, that 2,600 put is now in the money. And if that were an equity option, our brains would be screaming at us, to say we got to do something with this as we get close to expiration because that's in the money. We're likely to be assigned early. But guess what? This is an index option. This is a European style index option to be specific, which doesn't allow for early assignment. Therefore, we have, I'm not going to say the luxury, but we have the opportunity to let this go a little bit deeper towards expiration and see if the price moves against us. Now, that's a double-edged sword. There is some moral hazard there. The moral hazard is that we get complacent and we say, I don't have to worry about it, so I'm going to let it keep going further and further and further in the money, and then we end up taking max loss on that side of the trade before we manage it. So you got to balance that. If it really looks like the Russell 2000 is taking off and just rallying, then that may be a point at which, in this particular case, we would look at taking the trade off to avoid it getting deeper in the money and avoiding taking a bigger loss. Okay, so that being said, that's kind of the thought process here. But other than that, this short vertical spread, these two short vertical spreads combined to make an iron condor. If we go to the Analyze tab here really quickly, let's go to the risk profile graph, and we're going to go to RUT. There's our iron condor, and we can see what that iron condor is doing in this trade, and we can see those areas. So we know that at the moment, here's where the price of the index is, right? Here's where the price of the index is. Here's where our short strike is on our call strike. So we've got to see it kind of come back down in order for this to get back between those navigational buoys. It's not there at the moment. We could potentially even widen that side out. Now, here's the other thing I wanted to talk to you guys about. And I don't know if you guys have heard this, but I'm going to pop over here really quickly to an announcement that Cboe Global made, and they've been talking about this for a while. They made the announcement, and we just started offering these as a function of on Monday. But on I guess now this is called the Mag 10, but it's primarily the Mag 7 stocks that Cboe Global is going to list, or is listing now, expirations every Monday, Wednesday, and Friday for these stocks. Now, you're saying to yourself, well, Ben, this is a trading index options webcast. Why are we talking about these individual stocks, these individual equities, and the options that they are listing? Well, here's why. Let's pop back over here to the Thinkorswim platform, and let's go to the Trade tab, and let's take a look at, say, for instance, Amazon, AMZN, part of the Mag 7, and you can see where those expirations are. So here's a Friday expiration. That's 30 Jan. That's day after tomorrow. By the way, I'll be in Seattle. For those of you that are joining us for the live workshop, we're going to be in Bellevue, actually, specifically, on Friday and Saturday, teaching technical analysis and option strategies. But then there's an expiration on Monday. And then there's an expiration on Wednesday, the 4th. And then there's an expiration on Friday, the 6th. And then another expiration on Monday, the 9th. And then an expiration on Wednesday, the 11th. And so you can see how and this is on a single stock. They're gaining liquidity. So now these become much more like index options in that there are more frequent expirations. But the moral hazard is this. Remember, trading these options, you have early assignment risk. So a trader who's thinking, wow, this is really cool. Yes, and they list 2 weeks worth, Ted. You're exactly right. You caught that. They list 2 weeks worth of those Monday, Wednesday expirations. The Fridays are always going to be there on a rolling basis. But so what that means is, yeah, this is helpful. This is getting more like an index. And eventually I think there's going to be daily expirations. But keep in mind that these options have early assignment risk because these are American style. Whereas if we were looking at trading something like NDX options that have daily expirations, these are European style. So if you're considering a strategy that takes you shorter term, instead of trading those individual stocks that also have earnings risk and the potential for early assignment, one consideration might be using an index option to manage those positions or trade those positions so that you have that benefit of no early assignment. So something to consider. Exciting news for sure for options traders, but it is an important consideration. All right. So let's pop back here. We've got a couple of minutes left in this discussion. I want to pop back to that chart, and I want to open up this side, and I want to talk about, let's do this. Let's maximize this cell. So I want to talk a little bit about this probability of expiring cone for just a second, because a couple of people have asked the question. They're not very liquid at the moment yet. They're getting there, and they will get better. They will get more liquid. All right, so here's how I get to that probability of expiring cone. I'm going to go to the Flask icon up here at the top. I'm going to type in probability of expiring, and I'm going to put that probability of expiring cone in here. Now, I can change it with the gear icon. I've got 30 periods, so I'm showing 30 days out into the future, basically, if this is, if this is daily chart, okay? The probability range is 68%. That incorporates one standard deviation, okay? That 68% probability incorporates one standard deviation. You could change that to incorporate beyond that, 2 standard deviations. But this is by default one standard deviation of movement, which is also very, very close. If you go to the trade tab and you come over here and say on the trade tab, let's say we go out to that 14-day time frame. Let's put this on the SPX because that was what was on the chart. We go out here to that 14-day time frame, and our expected move based on implied volatility is about 160 points up or down, absolute value. That's going to correspond very, very closely, although not exactly, with the range here indicated by that probability of expiring cone. And you can see that probability of expiring cone has already moved a little bit because implied volatility has moved. If implied volatility increases, that cone is going to widen. If implied volatility decreases, the cone is going to narrow. So to Frank's point, how do you choose a strike? We identify the time at which we want to choose the strike, and then I just simply draw a line where that intersection is. And you can see that that intersection has moved a little bit, as it did the last few times we placed this trade. So that's exactly how we would use this trade. Now, if we were going to put this on a shorter time frame, let's put this on a 5-day, 5-minute chart. You can still have that probability of expiring cone, but you may have to kind of squish this out and change that cone a little bit. Whoops, let's go back here. Let's go to the Flask icon, and let's go back here. And I think we can do that. Can we do the probability of expiring cone on a shorter time frame? Oh, we can. Because I think by default, it is set to days. I'm going to investigate that because I think there's a way to do it. We might have to get Mike Fairborn to script that for us using the ThinkScript functionality. So we'll talk about it. We'll look at that possibility here of maybe scripting that probability of expiring cone. Good question to ask. All right. So you can follow us on X and on LinkedIn. Again, I'm at Ben Watson CS. Connie is at Connie Hill CS. If you want to learn more, we've got some great Trader Talks webcasts here. All we ask is that you click on subscribe right here. And then you can find more about us as coaches and more about our live webcasts, our on-demand webcasts, our in-person events, and about us as coaches right here at schwab.com/coaching. My thanks to Connie Hill for helping out here. My thanks to our great production staff and our great reviewers, and certainly most of all, thank you to all of you for joining us. Have a great day, everybody. If you're going to be in Washington this weekend, I will see you there. If not, I will see you back here next Wednesday for another Trading Index Options. Take care, everybody. Bye-bye.